1907. The United States has 72 hours before total collapse. Every bank is failing. Wall Street is in free fall. The government is paralyzed. One man locks himself in a library with the most powerful bankers in America and refuses to let them leave until they solve it. His name is J.P. Morgan, and this is the night he saved the country, then made them pay for it. But this story doesn't start in 1907. It starts 40 years earlier with a skinny kid everyone underestimated. Hartford, Connecticut, 1857. 20-year-old Junius Morgan gets a letter from London. His son, John Pierpont Morgan, just got fired. Again, third job in 2 years. The kid's arrogant, impatient, can't follow orders. Every boss says the same thing. Brilliant, but impossible to manage. Most fathers would be furious. Junius sees something else. His son doesn't fail because he's incompetent. He fails because he refuses to work for anyone less intelligent than himself. That's not a weakness. That's a weapon if you aim it correctly. Junius makes one decision that changes American history. He doesn't lecture his son. He sends him to New York with a simple message. If you can't work for anyone, work for yourself. 1861. J.P. Morgan is 24 years old, running a tiny office in Manhattan. The Civil War just started. The Union Army needs rifles desperately. A man approaches Morgan with a deal. 5,000 rifles available immediately. But there's a problem. These aren't new weapons. They're defective carbines the Army literally rejected and sold as scrap metal. The seller bought them for $3 each and wants to flip them to the government for $22. Morgan knows exactly what these rifles are. He finances the deal anyway. The Army accepts delivery. Soldiers fire them. The rifles malfunction. Some backfire. Men lose fingers. A congressional investigation follows. Morgan's defense. He was just the banker. He didn't sell the rifles. He provided capital. Technically legal. Morally devastating. The commission can't touch him. He made $5,000 profit. More importantly, he learned the most valuable lesson of his career. The line between financing and responsibility is whatever you say it is. But one deal doesn't build an empire. What happens next does. 1869. Morgan is watching the gold market like everyone else on Wall Street. Two traders, Jay Gould and Jim Fisk, are secretly buying every ounce they can find, trying to corner the entire market. If they succeed, they'll control the price of gold in America. Morgan sees the scheme forming and makes a calculation. He doesn't try to stop them. He positions himself for the aftermath. September 24th, Black Friday. The gold corner collapses. The market crashes. Dozens of investors are ruined overnight. Morgan isn't one of them. While everyone else was gambling, he was building relationships with the people who'd still be standing when the smoke cleared. Not the flashiest move, the smartest. This becomes his pattern. Let the gamblers chase quick wins. Morgan plays the longer, quieter game. But quiet doesn't mean passive. 1879. William Vanderbilt controls the New York Central Railroad, the most valuable transportation company in America. He wants to sell 250,000 shares, but there's a massive problem. If he dumps that much stock on the open market, panic selling will crash the price and destabilize the entire railroad industry. Vanderbilt needs someone who can move $30 million in stock without causing a panic. That's not a banker. That's a magician. He calls Morgan. Here's what Morgan does. He doesn't sell the shares in New York. He takes them to London and sells them to British investors in private negotiations over several months. No public announcement, no market panic. The stock price stays stable. Vanderbilt gets his money. Morgan takes a commission most people didn't know was possible. The deal makes Morgan the most connected banker in America. Railroads, steel companies, and mining operations start coming to him not just for money but for strategy. He's not just financing businesses anymore. He's redesigning them. 1885. A dozen railroad companies are bleeding money, building parallel tracks to the same cities, slashing prices to steal each other's customers. It's financial suicide on a massive scale. Morgan gathers all the railroad executives in his private train car and delivers one message: stop competing or I stop lending. They listen. Morgan brokers a truce. Routes get divided, prices stabilize, the railroads survive. But Morgan just did something unprecedented. He didn't just influence an industry. He restructured it by force of will alone. By 1890, Morgan isn't just wealthy. He's systematically important. If he stops lending, industries collapse. That's not power. That's infrastructure. And the government is starting to realize they don't control it anymore. Then, 1893 hits. Banks start failing. Railroads go bankrupt. Unemployment explodes. The Treasury's gold reserves drop to dangerous levels. President Grover Cleveland needs $100 million immediately, or the United States defaults on its debt. Cleveland has one option. He calls Morgan. Morgan doesn't just loan the government money, he demands terms. He takes control of how the gold gets distributed. He dictates which banks get access. The United States government just became a client. Not a partner, a client. But that's still not the moment that defines him. That comes 14 years later on one October night when everything falls apart at once, and Morgan has to decide whether to save the country or let it burn. What he does in that library doesn't just rescue the economy. It reveals who actually runs America. And it's not the president. October 1907. The Knickerbocker Trust Company collapses. Panic spreads through Manhattan like a lit fuse. Depositors flood banks demanding their money. Banks don't have it. They never do. The entire system runs on confidence, and confidence just evaporated. Within days, the stock market is in free fall. Brokerage houses are failing. The mayor of New York warns that the city itself might go bankrupt. It can't make payroll. There's no Federal Reserve, no emergency protocols, no government agency designed to handle this. There's just one man everyone turns to. Morgan is 70 years old, semi-retired, but when the crisis hits, every banker in New York ends up in his office at 23 Wall Street. He doesn't waste time on speeches. He locks them in his library. Literally. The doors close. Morgan sits at his desk playing solitaire while financiers argue behind him. Hours pass. Someone tries to leave. The doors are locked from the outside. Morgan doesn't look up from his cards. You're not leaving until we fix this. He's holding them hostage until they agree to pool their resources. Shortly before midnight, they break. They'll contribute. Morgan allocates who pays what, not the government, not a committee. One man at a table deciding which banks survive, but that only stops the immediate bleeding. The real problem is the Trust Company of America. It's hours from collapse, and if it goes down, it takes a dozen other institutions with it. Morgan needs $25 million by morning or the contagion spreads. He can't get it from banks. They're tapped out. So he turns to the one group with liquid cash, the church. At 2 a.m., Morgan calls a meeting with religious leaders and university presidents who manage endowment funds. He explains the situation in blunt terms. If this trust fails, your institutions lose everything anyway. Lend now or lose it all later. They agree. By dawn, $25 million is pledged. The Trust Company of America opens its doors. Depositors see it still operating. The panic eases slightly. But Morgan's not done. The New York Stock Exchange is about to collapse. Trading has nearly stopped because brokerage firms can't get short-term loans to cover transactions. If the exchange closes, the panic becomes irreversible. Morgan gathers the bank presidents again. He needs $23 million in 10 minutes to keep the exchange open. 10 minutes. One banker hesitates, starts doing math. Morgan slams his fist on the table. This is the time to gamble. The money appears. The exchange stays open. The market steadies. Over 6 weeks, Morgan orchestrates the entire rescue personally. He decides which institutions get saved and which get liquidated. He forces mergers. He moves money between banks like pieces on a chessboard. The government watches from the sidelines. President Theodore Roosevelt, the trust buster who spent years trying to limit Morgan's power, has to deem it the obvious. Without Morgan, the country collapses. But this rescue comes with a cost. To stabilize the crisis, Morgan allows U.S. Steel, a company he controls, to acquire the Tennessee Coal and Iron Company. It's technically a monopoly move, exactly what Roosevelt has been fighting against. But Roosevelt approves it anyway because the alternative is economic catastrophe. Morgan just proved he's more essential than the president. That terrifies people. Congress launches investigations. Newspapers call him an oligarch. Reformers demand that one man should never have this much control again. They're right. In 1913, 6 years after the panic, the Federal Reserve is created specifically to ensure no private banker ever holds this power again. Morgan dies that same year. Some say the investigations broke him. Others say he just knew his era was over. His estate is worth $80 million. Impressive, but not Rockefeller money, not Vanderbilt money. People are confused. He was the most powerful financier in history. Where's the rest? His son explains. Most of what Morgan controlled wasn't his. It belonged to clients, institutions, investors who trusted him to manage it. His real wealth wasn't money. It was access, relationships, the ability to make one call and move $100 million. You can't inherit that. Morgan's power came from something you can't pass down, the trust of every entity that mattered. When he said something would happen, it happened. That's not wealth, that's gravity. Today, we remember the Rockefellers for their oil monopoly. We remember Carnegie for his steel empire. But Morgan? He's weirdly absent from the conversation, maybe because what he built wasn't a product. It was the system itself. He didn't just make money from capitalism, he redesigned how it operated. Every central bank, every financial regulation, every crisis response protocol exists because Morgan proved one man could hold an entire economy hostage. The 2008 financial crisis, the emergency Fed meetings, the too big to fail doctrine, all of it traces back to October 1907 when Morgan locked bankers in his library and refused to let them leave until they saved the country. We built institutions to replace him. But the question those institutions keep failing to answer is simple. What happens when the crisis is bigger than the system designed to contain it? Morgan had an answer. He decided. No votes, no committees, no debates. One man with enough credibility to say this is what we're doing, and everyone listened. We don't have that anymore. Maybe that's progress. Or maybe we just replaced one unaccountable king with 1,000 unaccountable bureaucrats and called it democracy. Either way, Morgan's legacy isn't the money he made. It's the moment we realized someone had to be in charge, and for a few decades, it was him. Now no one really is. That's the world Morgan left behind. No single person powerful enough to simply decide anymore. Just a system that keeps asking the same question. When everything's falling apart, who's actually going to fix it? We spent a century making sure another Morgan could never exist. We might have succeeded. Whether that makes us safer or just more vulnerable is something we'll find out the next time everything breaks at once.